Good morning, everyone. Thank you for joining us for today's CalTRUST market update after last week's Fed meeting. Joining me today, as usual, is Will Goldthwait, our client portfolio manager at State Street Investment Management. As most of you know, State Street Investment Management is our CalTRUST investment management team, and we are very fortunate to get Will's time for these webinars with you. So please make this interactive. Use the chat, use the Q&A, ask us questions, give us comments. Feel free to make this your webinar and ask us what is useful information for you. And we will attend to those as we go through. But without further ado, I'm just going to hand it over to Will and talk to me. What is going on?
Yeah, seriously, what is going on? I wish I knew. Okay, so we'll go right to the Fed and what they did. I think that's probably a decent place to start. Obviously, didn't do anything with rates. Here's what's interesting about what's going on in the money markets right now. We went from really central banks globally, developed market central banks, Bank of Canada, Bank of England, ECB, Aussie, New Zealand, Swedish. Central banks were still in easing mode. Granted, many of them have stopped. Okay, so check me on Bank of Japan. But many of them had stopped, like the ECB, but we were not in a place where we were pricing rate hikes. Over the last 3 weeks, with the energy shock, somewhat bizarrely, and I had lunch with Simona Makuta, who's our chief economist, just an hour ago, and we're just a little bit confused why the market now is pricing rate hikes. And in the United States, there's a tiny little chance that the Fed will raise rates according to market pricing. So that's very important to distinguish. This is not what the Fed is saying. In fact, the Fed is saying that they're going to cut interest rates once this year, according to the dot plot. But the market is now saying, no, you're not. There's a risk that you have to raise rates. Well, why is that? Because the inflation word. Okay. Here's the problem in trying to square that circle is that an energy shock is a potential recessionary type thing, in my opinion. Um, oh yeah, I do need to say my little compliance thing. So none of this is investment advice. Don't rely upon it as such. Do your own research, all that stuff. So sorry, I meant to say that at the beginning, but I just said it there real quick. So here's the challenge. You know, a dollar towards energy is not an additional dollar that you have, right? If you go to the gas pump and you fill up your car and it costs you 20 additional dollars to fill up your car, or it costs you 20 additional dollars to cool or heat your home, that's $20 that then gets allocated away from something else, right? This is very different than what we experienced in 21 and 22. In 21 and 22, what was happening is there was a shortage of labor and we were seeing significant wage inflation. People were getting paid more money. That being paid more money then immediately means you can turn around and spend that more money on something. This isn't that. This is an energy shock that is then going to replace, or sorry, that's then going to eliminate your ability to spend that additional dollar on something else. You have to spend that additional dollars now on a tank of gas. I can't go out to eat. I can't buy a new pair of pants, whatever it is. So that's a very different thing. But what it does do is it creates this perception of inflation, and CPI, headline CPI, which includes food and energy, will pop higher and be like, oh my gosh, it's now running at, X percentage points above what it had been. So that's what has central banks nervous. When you look at the Bank of England, they voted 9-0, 9 votes to 0 to leave rates unchanged, and they all showed a bias towards raising policy rate based on this inflation pressure. That seems absolutely crazy to me, because if we do get a real change in the cost of energy, that is going to be very, very disruptive to the entire business. So what the Fed told us last Wednesday is like, too soon to know anything. We need to take a beat. We need to wait for resolution, or at least a path on this conflict with Iran. And we need to sort of see how things shake out. I think everyone feels that way. There's tons of uncertainty. There's tons of chaos. There's an incredible whipsaw. European markets, when they opened this morning, which is about 2 a.m. Eastern time, um, they were down 2%. Trump came on and started to post on his Truth Social saying how the war is going to be over. We're going to enter into negotiations with Iran. I think peace. And then all of a sudden, those markets were up 2%. So a 4% swing before the US market even got to work that day, this morning. So that's the sort of volatility we're dealing with. The other thing that's causing interest rates to move higher right now is we're seeing um, repositioning going on in the market. And so folks are maybe taking off some leverage, maybe unwinding some trades in the rate space, and just being a little bit more cautious in the fixed income market. In the equity markets, we're actually seeing people adding to positions, so adding to shorts, adding to longs. And so that's been an interesting phenomena to work. But I think for the most part, we're really all waiting and watching and seeing, how things go. How am I doing, Laura? Any questions thus far?
No questions thus far, but I do think it's really interesting that it's giving that inflationary look, even though it really is the opposite. When you look at it globally, is that something that we're seeing on a global level, or is that more kind of how the US perception is right now?
No, it's global. So
Okay.
it's very interesting. There's been a complete switch as far as what the market is thinking. I can't emphasize that enough,
Yeah.
that this is what the market is pricing in now. This whole idea. I mean, you know, it's very enticing to us to think about, yield on 1 year treasury bills right now. March 18, 2027 T-bills right now is a 373. We're looking at overnight repo levels are somewhere in the 360s, right? Less plus, sometimes in the 370s. So if we could lock up 1 year yields because our bias continues to think that the Fed has a few more eases to go, as they have described in their dot plot, one more cut this year, one more cut next year before they reach this quote unquote neutral. Um, I would want to buy that trade right now. I would want to lock up that 373 yield on 1 year T-bills right now. That makes a ton of sense. And from a credit standpoint, those yields are even higher. So what we have to do then is balance that opportunity with the uncertainty. And this is what, every listener on this call is doing the same thing, right? You're balancing opportunity with uncertainty. Do I want to spend that money out the curve when I'm not quite sure what is needed for that money in the near term? What our belief is right now is that we want to sort of pull things a little bit closer to home. We want to build a little more liquidity. We want to be very careful about redeploying capital, buying the curve, because we'd love to see our liquidity numbers nice and healthy just in case something goes on, right? There's a lot of variables out there in the global stage right now. Never mind Middle East, but then we also have to remember we still have the Russia-Ukraine situation. Um, we still have the Venezuela situation. There's still, some uncertainty, a reasonable amount of uncertainty in the world. And then what does that all mean back here at home as far as the overall economy? Let's not forget tariffs are still a thing, right? That uncertainty around what the price of something is going to be in the future.
I
So
like
we feel
losing track of all the uncertainties these days.
right, exactly, exactly. And the headlines, continue to have us guessing, right? As the headlines whip around, and we're not quite sure what to do about all the headlines. So it does seem to make sense to build that liquidity, be a little bit safer. And this has been a theme that we've been talking about for really 2 years now, where we talk about being, long duration. Well, now we're just going to try to trim that duration a little bit, but cautious on credit is something we've been talking about for a long time.
When we think of, how it seems that the perception right now, your take is that we're looking at probably one more rate cut this year. Is there an idea on perceived timing? Do you think that would be later this year? Is there an expectation it would happen earlier in the year? I mean, we're only in March, right? There's a lot of year left to go. Are there
Yeah.
thoughts around that?
Yeah, absolutely. And I'm glad you brought that up because I do need to differentiate between what the Fed is thinking, one more rate cut, and then what we're thinking.
Mm.
And my lunch with Simona, she said she's in the middle of generating her second quarter forecast. Recall that at the beginning of the year, she had three rate cuts penciled in for this year, which was very much an outlier stance. And she is thinking maybe she reduces that to two, but she still feels that the concern around the employment market, the concern around the labor market is something that needs to take a little bit more space. In other words, we need to be talking about the labor market a little bit more. And, we've all seen the articles about AI. We all know that this is a new technology that is definitely super innovative. I'm sure every single person on this call has used it to some extent and found some of the great advantages it has in doing certain things. And so that is definitely something we think about in the context of the labor market and what does that mean for the labor market. So she's not ready to, well, she'll soon release her forecast. I don't know exactly what that, but it's going to be somewhere between three and two cuts this year as our call and State Street's call, her call. And the belief there is that the labor market is the market that needs to be worried about. And I've talked to young people, I've talked to people my age, and it's hard, right? We know that finding work now is not just a layup. It's taking good work. You got to grind at it. We've seen that in the data. The data shows that even though the unemployment rate is low, the length of time it's taking people to find work is longer. The statistics show that it's longer. And so we just know that there's some challenges in the labor market. One of the things that's keeping the unemployment rate low, we've talked about this, I believe, is the supply of labor. We've got immigration has basically been stopped and the baby boomers continue to leave the labor force. And that's a really big contingent of the population. It's 70 million people that are almost entirely out of the labor force. I think the youngest of the boomers is now 63, 64, 65, somewhere in there. So those folks have almost matriculated out of the labor force, and so then it's just where are we going to find those new workers to expand the workforce? Um, if the participation rate was that what it was, certainly back in the late 90s, early 2000s, before the financial crisis, we'd have about a 10% unemployment rate right now.
Wow.
So, so if we had that number of people that wanted to work in the labor market, we would have about a 10% unemployment rate. So I think it just goes to show how demographics can have a huge impact on what the other statistics, how the other statistics look, right? So just because there's fewer people that want to work, it means the labor market is tight because there's just less
What,
supply of workers.
what's our current um
Four,
count?
4.4.
4.4? Okay.
Mhm.
That's huge.
Yeah, big,
That's
big number.
really
Big,
interesting.
yeah, big number. Um, So yeah, so the summary of economic projections, which is, as you know, is the Fed's, forecasting tool for prices, employment, and GDP, all show that it's somewhat weaker, that inflation is a little bit higher, that unemployment is a little bit weaker, and that growth is a little bit weaker. Nothing dramatic, but definitely changed a little bit. The dot plot didn't change. I mean, it changed a little bit in composition, but that median dot still represents just one cut this year and one cut next year. Um, and so then the next question I guess you'd ask is, well, what about this Fed transition? And I guess we'll come back to the Iran conflict. And we've published a lot of good stuff, which folks should reach out to Laura if they want to get some of the stuff that we've written. She can pass it over to you. It's also up on our website. But a guy named Elliot Hentoff does a lot of writing for us on the war, and so we're happy to get that to you. Um, so when we think about Fed transition and Kevin Warsh coming in, I suspect my personal opinion is that it's going to look very similar to what Jay Powell is doing. So I think people are saying, oh, Warsh, he wants to shrink the balance sheet and he wants, to ease policy rates. But I would suspect that when Warsh actually comes in and, presents for the first time in a press conference, or whether it's a Humphrey Hawkins testimony, I would suspect it's going to sound very, very similar to previous chairmen, to Jay Powell, to Janet Yellen, to Ben Bernanke. I wouldn't expect anything too dramatic from a sort of Fed speak standpoint. And also recall, Kevin Warsh was a front runner, really the runner-up to Jay Powell in 2018 when Jay Powell was appointed as chairman. So this is a highly qualified person. I don't think he'll have any trouble moving through the confirmation process in the Senate, and I think he's very institutionalized. He knows what the Fed does. He knows the value of the Fed. He's very eager to get the job. So I think he said all the right things to the president in order to get the job. But I don't think he drifts too far. Some people are saying, "Oh, he's going to come in and cut rates." No, he's one vote amongst 12. And, we joke if you've ever been in a room full of economists, they're a very opinionated group of people. So his job is more going to be talking and convincing that group so that they can sound uniformed and aligned, as opposed to coming in and saying everyone needs to vote for a rate cut. And no one's going to vote for a rate cut in light of these inflationary challenges we're seeing in energy. Everyone's going to probably just say, let's wait and see, let's wait and see.
Do
So,
you think so we have the next Fed meeting is the end of April, April 28, 29. Warsh is
mhm,
coming in mid-May, right, or May 15th. And then the next Fed meeting after that, he'll be in for about a month, I believe, before
mhm.
the June meeting. Do you think him coming in so quickly after the April meeting, just having that 2 weeks, would be impactful as far as if the Fed would be kind of just more cautious and less likely to do anything and kind of standoffish in April with that transitioning happening so soon? Or do you think that would not necessarily be a direct effect on how their perceptions are and how, that meeting goes?
Yeah,
Pure opinion question.
yeah, no, it's good, it's good. So there's one thing to note is that Senator Tillis says he will block the confirmation process um, until the DOJ resolves.
Okay.
So we know that Janine Pirro is the attorney that's brought charges against Powell. And Tillis has said that until that's settled and resolved, now a judge threw that out, and that was in the Q&A that
Yeah.
Laura, you distributed, last Wednesday. And so you can read about, what exactly the judge said, but essentially the judge found it to be a very politically motivated charge, and that it was sort of it sent Attorney Pirro really back on her heels as far as that. So that's still out there, but let's just say between now and the 1st of May, the DOJ drops charges and we move on. I'm guessing that Kevin Warsh is already having conversations with the various members of the FOMC. I mean, there's no prohibition to him being able to pick up the phone and have a chat. And they're also probably going to be speaking. The Fed does a really good job. The presidents and the members of the FOMC do a really good job of speaking at various events to make sure that they let everybody know, what they're doing. Recall when Stephen Miran, who is an Uber dove and wants interest rates cut. In fact, he was the only dissent in the last meeting. Um, he Like, it was amazing. He was on every single news talk show and every was being interviewed by every podcaster and the rest, trying to get his views out there. So this is how the Fed communicates their views, is by giving speeches and talking about how they're thinking about the economy and that sort of thing. So I suspect Kevin Warsh won't be much different. I think we're going to start to hear from him, and he's also going to start communicating with the other officials. So, um, so to answer your question, I don't think him coming in the middle of May and then having that first meeting in the middle of June. I don't think that's going to be too much of a challenge. He's also, he's been there before. He knows what it's like to sit into these meetings. This would not be his first rodeo.
Okay. Okay.
Um, okay, so I do want to talk about the conflict in Iran a little bit. There's there's things that are there's really one thing that I think Elliot mentions, what I think is very important. There's very much a difference between when the war ends and then when the war ends for markets. And I think that's a pretty important distinction. When the war ended in Iraq, it was years. When the war for markets ended in Iraq, it was months. And so I think that's something that we're waiting for. And in fact, arguably, the market might already be looking through and anticipating the end relatively close. And here's one of the things that I looked at. Oil right now is priced at about $100 a barrel for Brent. Um, and in a year's time, that price is about 75-ish dollars. So the market is essentially telling you this thing is going to get sorted out and oil prices are going to resume a normal look and the flow of oil is going to resume and things are going to go back to a peaceful type environment. And I think everyone is aligned for that. Iran, the Gulf states, the rest of the world is all aligned for the regular flow of energy to resume. So, and I think the president is in some of his comments of late has made that very clear that he's wishing for this conflict, most recently on the tape, wishing for this conflict to end sooner. Um, so with that said, then you have to look at the inflation forwards, and the inflation forwards are telling us the same thing. Um, so I don't want to minimize the tragedy that war is, and I certainly don't want to minimize lives lost and the destruction. It's terrible, terrible, terrible. But the market, the way I see it right now, is really anticipating the end being much sooner, and then sort of things start to move on again. And I think that's just an important thing to recognize in this whole construct. So if we were sure of our cash flows, right, then we would be buying the curve, right? We would be buying that duration. We'd be locking in those yields because then when we think about ultimately the resumption of the path that we were on, we think that resumption is lower yields. But that's not why we're being cautious. We're being liquidity managers. We want to make sure that we have all of our ducks in a row in the case that we have a left or a right tail event. And so we want to be very careful about that. So I think that's a very important distinction when you talk about the war ending and then the war ending for markets.
Yeah, that is a really interesting distinction. So we're down to our last 5 minutes right now. Again, anyone please participate in the chat or the Q&A. But as you're looking at it in the next, let's say, 3 to 6 months, what are kind of our hot button issues that we should be keeping an eye on, and what are you guys really looking closely at right now? What's
Yeah, I
keeping you
think
up at night?
sorry.
Said, what's keeping you up at night?
Yeah, exactly. Well, it's so funny because that question was asked this morning in an internal call to Todd Bean, who runs our U.S. cash strategy. He goes, I sleep very well at night. And I think that's a testimony to how we're positioned.
Okay.
We are positioned cautiously. Most recently we had the head of our global cash credit research speak on an internal call. And he said banks from where they are right now are very well positioned, very well capitalized, and very resilient against a downdraft. It doesn't mean that we're not going to see idiosyncratic challenges, of course. Those will always come to be. We saw two last year in the auto sector. And those will always come to be. And we can look back at history and look at the mini banking crisis of 2023. There's always going to be pockets of idiosyncratic risk. But I think overall, when we think about the system as a whole, so systemic risk, as we like to call it, um, we feel very confident in the banks and the bank positioning and all of the regulatory changes that have been thrust upon those banks in order for them to be resilient. What is that is, they have double the capital that they once had. They have liquidity metrics now that they have to meet, high quality liquid assets, liquidity coverage ratios, supplemental leverage ratios. There's a whole bunch of different metrics that are thrust upon these banks that make these banks very resilient. Um, are we seeing defaults increase? Yes, we are seeing defaults increase. We're seeing some of those companies that are at the margin, right, that are highly leveraged, that are exposed, that perhaps weren't positioned for higher interest rates overall. They're going to get beat up a little bit. So those companies that are vulnerable, they're at risk for sure. Those are not the companies we invest in. And so I think that's just important. So to answer your question, we are sleeping well at night because we are positioned. Um, we've been talking for quite a while about being long rates, long treasuries, and being cautious on credit. And that view is bearing out right now, just given the uncertainty. And that uncertainty, yes, is of course over the last 3 weeks with the war, but that uncertainty has started to bubble up, in January of 2025, when sort of weren't sure what he was going to say next, what he was going to do next, and uncertainty. The tariffs came to be, and I was looking at the S&P 500, and the last downdraft it had, significant downdraft it had, was in April of last year when the tariffs were announced. So there's going to be more of that. We know that, and so we're positioned for that.
I can't believe that was April of last year.
It's
Almost
amazing,
a year
right?
now,
Time
right?
flies. Yeah, time flies.
That's great. Oh, well, we are pretty much at time right now, it looks like. So I'll just ask if you have any final thoughts before we wrap this up.
Yeah, stay tuned. We'll keep you updated. Laura will keep you updated. Sorry, you will keep us updated with stuff that is share worthy, and always encourage folks to reach out. Always happy to get on the call and get into more detail, Laura. So very happy to do that.
Yeah, and we'll be able to share Simona's revised outlook, right, when that comes out.
Yes,
So
absolutely.
keep an eye out for that. Everyone, we are right on time this morning. So thank you so much, everyone, for spending part of your morning with us. Will, thank you for joining me for part of your afternoon. Appreciate it. It's always great. And it has been recorded and this will be available online the next couple of days. So thanks so much, everyone. If you have any follow-up questions or want to have any further questions or conversations with State Street, feel free to reach out to me and we can arrange that. So have a wonderful day. Thanks so much.
Thanks, everybody. See you
Bye.
later.